the one leg of the Indian economy which probably still survived well is consumption, though it's has started showing a bit of chink in the armor as well. Some companies out there have shown both positive and negative performances. Dollar Industries has been taking a hit on margins for a few quarters now as well. It's prompted the company now to get a consultant to fix the supply chain. Joining us now about the importance of this, the possible remedy and the eventual target set by the company is Vinod Kumar Gupta, MD of Dollar Industries. Mr. Gupta, good having you. Thanks so much for joining in. Can you tell us a bit about this? Do you believe that this is the Achilles heel for your company, and how do you plan to go about resolving it? What are the targets that you're setting for yourself?
We are right now transforming from a push-based model of business to a pull-based model of business. The current push-based model has held up, established and grown to a certain level. But then again, that requires high amount of working capital and schemes to the retailers. It also limits our reach and range in the market. That's why to get into the next leap of growth, we need to reach out to more and more customers all across the country and offer them a wide range of products. For this, we need to reach a maximum number of retailers with all through the ranges, which is only possible through a pull-based model of business. And there we need to service them as many number of retailers all across the country as many. This entire chain, right from operation to the retailers, will be on pull-based replenishment model. And this will help us to ensure availability of our maximum range of products at the maximum number of retail points.
An expert that we were talking to, Mr. Gupta, suggested that the Indian consumer is not averse to buying, just that the last 6 to 9 odd months, because of the liquidity issues and the credit crunch, the product was not available on the shelves in the way it should be. Would you concur here? Have you also been a victim of that we've not been able to reach out to the customers in the same vein that you would have loved to?
Yeah, there was a bit of slowdown in terms of rural demand, but then this winter is going well, and we are hoping to close good numbers in third quarter.
Okay.
And to register a good amount of growth on a quarter-on-quarter basis.
Okay, no, but you are saying that there was a bit of a demand lull. What we got to understand also, that while there may have been demand, the supply chains were not strong enough for various products, and companies are not able to supply their products in the entirety to all the nook and corners that the products otherwise go to. Is that a right assessment?
It is not right. It is not right to say that we have not been able to reach our products to the point of sales. The demand was sluggish. The supply chain was almost, it was good, and we were trying reaching out to as many retail points as much we can. Okay. And we really did that also. But since the demand was sluggish and there was, of course, a little bit of liquidity crunch in the market, that kept us at a stagnant level in first half of this current fiscal.
Okay, but and yet you are going out and devising a completely new strategy of streamlining your supply chain then. If the supply chain was not an issue, why is it that you're doing this? To make it more efficient or to correct some of the issues that are there in the supply chain?
Yeah, as I told you earlier, that we are now transforming ourselves from push-based model to a pull-based model.
So that's the only reason.
Have to reach out to the maximum number of point of sales in the entire country. And that's what we are doing right now.
Okay, so it's not an attempt to correct what is broken, but an attempt to try and expand from where you are right now in terms of the touch points available. Is that a correct assessment?
Right now our products are available on almost more than 1 lakh point of sales. But then we have now attempted to reach out to more than 4 lakh point of sales in next 2 years of time.
Okay. Just wondering, what kind of capital outlay would such a thing entail, and do you think your margins could take a hit as a result of that?
No, not at all. The margins will be much better because, as I told you, we are now transforming from push to pull. Once you are on pull-based model, ultimately your working capital cycle gets much efficient, and you will not have to. You will have to part with a little amount of schemes to the retailers. So that is going to increase your bottom line, increase your business, and of course, at an optimum working capital cycle.
Okay, so can you, by the way, just a brief update, the Sensex is now trading at record high. So we were talking about this possibility that yesterday may have been a bit of a lull, but today the markets may start reviving, and that's what's happening right now. 250 points up for the Sensex, and the Nifty 52 about 66 odd points, 0.5% in the green. I think the Bank Nifty is leading the charge, up about 0.63%. So yesterday's lull has been bought into. Mr. Gupta, a couple of final questions. Can you tell us about some targets that you set for yourself? You mentioned about the touch point targets, that from the current 1 lakh odd that you have, you plan to reach up to 4 lakh in 3 years. What about revenue targets? What about margin targets? Not just for FY20, but let's say FY21 or FY22.
See, we have set our targets to reach out to say a turnover of 2,000 crores by the end of March 2024. That's the target we have set. And to reach out to those targets, of course, as I told you, that we are just transforming from push to pull. And we are also increasing the number of SKUs on the shelf. Once your POS, I mean point of sales, gets increased by 4 times in say 2 years of time, so ultimately to reach out to that 2,000 crore target in by March 2024 will be an easy task for us to reach. And then now in terms of bottom line, of course, once your working capital cycle gets improved, your margins, of course, they are much better in the years to come. So we are envisaging that we are going to do something really good in the years to come.
Just wondering, one final question, Mr. Gupta. As if I look at your numbers for the year ended FY19, your revenues were about 1,000 crores, 1,028 to be precise. If you're looking at 2,000 crores by FY24, that would mean a CAGR of 13 to 14 odd percent. Is that the growth rate, CAGR, that we are looking at for the next 5 years?
Yeah, that is the best we are looking at.
Okay, and you believe that the bottom line CAGR can be better because margins will show an improvement from where they are right now?
Yeah, they will really show an improvement because right now the cotton prices are also at the bare minimum. I mean, in second quarter this year, the cotton prices were too high. Now the cotton prices are also getting stabilized, so the margins will surely be improved.
13 and a half to how much, Mr. Gupta?
It will improve by again that CAGR rate of 10 to 12%.
Okay, so you might actually reach about 14.5% by FY24.
Yeah.
Okay, Mr. Gupta, we'll leave it at that. Thanks so much for taking the time out and speaking to us at BloombergQuint. Appreciate your time.